Good day, everybody. It is great to be with you once again for Cartesian Talks. And with my wild and bushy hair, which I'll have to fix, otherwise Anthea is going to judge me. It is my great privilege to welcome both Anthea and our special guest today, Rapelang. The purpose of these sessions are for Anthea to get us going on investments, to help us make the most of our money. And as always, she has got a guest that shoots the lights out. I'm particularly delighted that we have with us today somebody of the stature of Rapelang Rabana. And it's again somebody which is similar to many of Anthea's friends and contacts that's difficult to introduce because they do so much. So computer scientist, entrepreneur, a tech legend, but I thought the best way to introduce her is to read a quote from our president, which I think is very true. The problem with us as South Africans is that we always put ourselves down. We always think that we're not as good as we are. And sometimes we even think that we don't have people who are at the cutting edge of knowledge, but we have them here. And Rapelang Rabana is one of those. So Anthea, thank you very much again for having us, and we look forward to what you're going to share. We're going to kick off with you setting the scene a little bit. And please don't disappoint, because the users have grown used to your amazing graphs that, that help us make the most of our money. So over to you, Anthea, and thank you very much.
Thanks, Carl, funny guy with the hair. But before I start, I want Llewellyn to show us a video. It's a graphic representation of the top listed companies by market capitalization. So when this video is playing, take note of how the types of companies change through the years. Particularly, actually, what you'll see is the dominance of the oil companies leading up to the time when oil hit $100 per barrel for the first time in 2008. It's another one of those, do you remember where you were when moments? And so if anyone cares, I was at Gatwick Airport on my way to France for a long weekend of skiing. And then in a couple of years, we'll all be saying, remember when we were in lockdown and oil futures turned negative for the first time ever, which was only a couple of months after Google parent company Alphabet became a $1 trillion company. So just watch this video and kind of see how the sectors that are in favor change through the years. Llewellyn, it's up to you now. So unfortunately, that video ends kind of last year, but I couldn't find a better one actually, so I chose to keep that one. So let me share my screen and get on with my presentation. So when I was thinking about this presentation or this webinar, I suddenly realized how old I am. I was going to start my presentation with, I'm sure you all remember what happened in 1999 and 2001, when every company started a dot-com division. Companies and venture capitalists spent millions of dollars on creating online companies for this new economy, as they called it. Shares traded at spectacular values, like, I mean, unbelievable. Price earnings ratios were through the roof. Yahoo at one stage, had a price earnings ratio of over 1,700 times. It was just crazy. Like, and these companies were most of them actually were consistently making losses. In fact, we used to talk about the cash burn rate, which was basically what a company spent every month to create their new online company for this, in inverted commas, new economy, while not generating a single cent of revenue. And then I realized that was 1999, it was over 20 years ago. But there I was, and in fact, I have a great story to tell. Do you remember Webvan? Not many people do. I've written about it in my books in a different guise. So if you want to hear the story from an equity pricing perspective, go and get my book. Anyway, Webvan was an online grocery store founded in 1996, the heady days of the dot-com boom. Silicon Valley investors, those smart private equity guys such as Sequoia Capital, SoftBank, Goldman Sachs, even Yahoo, invested close to $400 million in this online grocery. In November 1999, Webvan listed on the New York Stock Exchange and raised an additional, on top of the $400 million, an additional $375 million by selling just 8% of the company, meaning that at IPO, the company was valued at $4.7 billion. On the day of listing, the share started trading at $15, and then in intraday trading went all the way up to $34 a share. By the end of the day, the share had had a little pullback, but still, on its first day of trading, this share closed 65% higher than where it had started trading. So not a bad return for one day of holding the shares. And if you're good at maths, you've by now figured out that by the end of the first day of trading, investors had effectively pushed the value of the company to an eye-watering $7.9 billion. So at this stage of my life, I was working between London and San Francisco, and let it be known, I hate shopping. Initially, I lived in Marin County, which was just over the Golden Gate Bridge, and I get a lift home from the office, or I take a cab. So shopping wasn't really an issue. I could pop into the shops at lunchtime or even after work and get home quite easily, not having to worry about dragging my groceries on the public transport or up those hills. But then I moved to the city. And you know, some of the best car chase scenes in movies are filmed in San Francisco, because the streets are so steep and it looks very cool when you make a car fly over the crossroad. So what you're looking at now is a picture of Lombard Street, the windiest road in the world. The crooked part of Lombard Street, which you can see in the picture, was designed in 1922 after it was decided that the 27% gradient of the hill was too steep for most vehicles and even pedestrians. You do not want to be carrying groceries up that street. So Webvan was the perfect solution. I could order my groceries sitting at my desk during the day, take delivery from Webvan in the evening. So for me, this was the ultimate business. At the same time, I discovered Amazon, which had started delivering books and putting them online. I may hate shopping, but I love books. I really just love like acquiring the knowledge. I love the touch and the smell of a book. I love sitting in bookstores and drinking coffee and browsing. So while living in London, I spent hours at Waterstones drinking coffee and browsing. In fact, in South Africa, in 2018, I wrote most of my book in exclusive books in Hyde Park, where they have work tables and a coffee shop. The editing was done at So Yum Restaurant, but that's a story for another day. So this Amazon malarkey of kind of not letting me browse through bookstores and just delivering, like it really had zero appeal to me. I was a Webvan fan. I was going to, you know, get my groceries delivered, talk about ease, convenience. And I don't have to tell you the story of Amazon. Last year, their physical store sales totaled $17.2 billion. So what you're looking at now are in fact Amazon's actual bricks and mortar stores. Just for the record, Amazon's physical stores include 487 Whole Foods markets, so 508 if you include Canada and the United Kingdom, 25 Amazon Go stores, which are the cashierless stores. So you just go in, you pick your groceries, you put them on the counter, the machine calculates how much the basket is worth. It gets packed, or you pack it, I think, into plastic bags, you present your credit card, and you walk through the door. You don't have to interact with anyone. They have 21 Amazon bookstores still, so touch and feel books, 9 Amazon 4-star outlets, and this is kind of, I don't know, it's a pretend thing in my opinion, you know, like it's their top sellers only kind of store. And 5 presented by Amazon locations. So the presented by Amazon is kind of your, think about kiosks in a big mall. You have the little kiosks, not the actual shop that was presented by Amazon. So Amazon doesn't actually divvy out their online store sales. You know, so they won't tell you what Whole Foods versus, sorry, not Whole Foods, what the online versus the actual in-stores number is. But online store sales last year in the fourth quarter surged by 15%, just in the fourth quarter, to $45.7 billion. For the full year, online store sales were $141 billion. That's also about 15% up from the year before. So you must be wondering what happened to Webvan. A mere 5 years after Webvan listed on the New York Stock Exchange, this apparently promising company, the one I knew I was always going to use, which had raised so much money from Silicon Valley, went bankrupt. That's right, shareholders lost all their money. And worse yet, just to rub my nose in it, in 2007, Amazon launched Amazon Fresh. They spent $13.7 billion to acquire Whole Foods in 2017. And as I said earlier on, they no longer break down revenue generated by the online stores. So I don't really know exactly how much money they made with Amazon Fresh versus what they make with their other online stores, you know, the books and the CDs and, well, not CDs, music or everything else basically that they sell now. But I do know that in the fourth quarter of last year, Whole Foods sales doubled, as did Amazon Fresh. Of course, it just wouldn't be an Anthea presentation if I didn't have a graph. So have a look at the performance of this tech index, which is made up of 50% NASDAQ Internet Index and 50% MSCI Global Information Tech or indices of the index, sorry. So 50% NASDAQ Internet Index and 50% Global Tech Index. So really quite a comprehensive benchmark, if you like. The blue line is the tech index and the S&P, and the orange line is the S&P 500. You can see, I mean, I don't even have to show you numbers, how since March of this year, the tech index has outperformed the S&P 500 by well in excess of 20%. Then have a look at how the sectors in the S&P 500, which is really considered kind of the new style or new economy shares predominantly. Well, not the NASDAQ, but the S&P 500, it's got a lot, I'm trying to say it's got a lot of tech stocks in it. But if you break the sector down, look how you will see the technology and communications stocks since the beginning of this year have performed positively while other shares have declined significantly, or other sectors, I should say, have declined significantly. So again, we've seen tech stocks outperforming this year, just your ordinary, normal, in inverted commas, economy stocks. And so, of course, hindsight is perfect vision, right? And I can go back and say, well, you know, Webvan went bust, and if only you'd have been invested in Amazon, that would have been great. But and we're fundamental analysts. So let's have just a quick look at one of the ratios. This is the price earnings ratio for Amazon from 2006 to the beginning of April this year. And in 2012, the Amazon price earnings ratio went to 3,500, over 3,500 times. Now, who in their right mind would buy a share where it will take you 3,500 years to make back the money you invested through earnings of this company? Because basically that's what price earnings ratio is. The price you pay today compared to what the company is generating earnings for you as a shareholder per annum. So of course, 3,500 is 3,500 years. Right, so you would have been crazy to buy Amazon shares in 2012, but have a look at this. This is the Amazon share price. And in 2012, February 2012, the share price was $185. Last night, or actually, yeah, last night, it was $3,081. So there's this kind of, in investment worlds, like an almost crazy disconnect between price earnings ratios and what happens to the share. I want to bring you back a little bit now, because when I told you about the Yahoo share price earnings ratio at 1,700 times, the actual share price soon after that collapsed by 93%. I mean, so there has to be, you know, some sort of logic or basis for all of this. Here's another one. This is the Naspers share in dollars, because it is listed in the US. So the blue line is the Naspers share versus the orange line, which is the Naspers price earnings ratio. And again, if you look in the beginning, when the price earnings ratio spiked to 150 times, you're like, what crazy person invests in a share where you have to wait 150 years to make back your money? But look what happened to the share. It just keeps going up and up and up. So there's almost kind of no fundamental logic, if you like, to any of this. I know I'm recycling this slide because it just says so much about when you look at companies or tech companies, where you want to be invested and how you want to be invested. And I'm not sure, we'll talk to Rapelang about this, and I'm not sure that just buying into management of a company is the right idea. I mean, you know, there was nothing wrong with Webvan management. I think their timing was just terrible. There was not enough take up in their product or the delivery, even though I thought it was the best idea. Obviously, other people didn't. And the other problem with Webvan is that their cash burn ratio was just spectacular. Compared to Amazon, which I guess he was a little bit more conservative. He maybe grew a bit slower. He eventually basically launched a Webvan version in Amazon Fresh a couple of years later when he thought the market was ready for it. So I know why you're all here, generally for a stock pick. So I'm going to give you this. Before we switch back to home soil and talk about the local tech market, while you're deciding on whether to hold or sell your Amazon shares, do some work on this company. It's called Paychex. It was established in 1996, and they describe themselves as a thought leader in the international payments industry. I always worry about companies that do that. They describe themselves as thought leaders. You know, so their clients are banks, fintech, processors, vendors, companies, basically almost any company, but they do deal a lot with the fintech companies, and they're spread across 5 continents. In short, they're a payroll services business Basically, they pay 1 in 12 private sector employees in the US. Now, here's a point I think Rapelang and I might discuss or debate, is that the population of the US is 328 million people. It has a working population of 156 million. So even 88% or 1 in 12 of 156 million people, actually not even 156 million people, it's a smaller portion because it's only private sector. There's 670,000, they have 670,000 clients. And I think the point with Paychex, this business, is that they really are representative of the broader US economy. They're a great proxy for the US employment. And if you're ready to bet on the US jobs recovery, and you would have seen 2 weeks ago that payroll number spiked and the unemployment rate dropped by 3 percentage points, this is probably not a bad way to go. You know, they are exposed to the hospitality and restaurant space. And so what happened during the COVID crisis, when all the restaurants were closed, is that the share actually underperformed the S&P 500 significantly. Right, so enough from me. I am delighted to hand back to Carl now to bring Rapelang on.
Thank you very much, Anthea. As always, it's a great scene setter listening to you. And we always love your graphs, so don't apologize for them. It helps us make good investment decisions. So thank you very much. I also love how you weave in, as an asset manager, your personal stories, because I'm a firm believer that to be a really good investor, you need to be somebody who's taking in your surroundings and how you engage with the world. So it was fascinating. And I'm sure we're going to talk a little bit more about what you got up to in San Francisco. So let's hand over now to Rapelang. As I said, a bit daunting to introduce her. Like Anthea, does a million things amongst her day job. But Forbes Africa has also said 30 under 30. I mean, you are just an absolute dynamo. So thank you very much for joining us today. We really appreciate it.
Oh, thank you, Carl. The best introduction in a while.
And I'm going to shut up because people want to hear what you've got to say, and then we'll ask some questions of you and Anthea. So Rapelang, over to you.
Sure. Great to be on your webinar, Anthea. I think it's probably the slickest one I've been on, so congratulations. It's really great. And just listening to your graph and your speak and your graphs and looking at, you know, Amazon's journey over from 2000 to now, I mean, that's sort of 20 years already. And I get envious of the US market sometimes because the patience of the capital and the depth of risk that they're able to go to wait that long is really quite impressive. And it worries me a lot when we look at the African context, because we like to talk about the 4R and we like to talk about becoming producers of technology instead of just consumers. But are we really willing to look that long term? And in my experience, it's really been too myopic.
So, Rapelang, that's such an interesting debate, because I find one of the things is that, you know, when you look at the American context where these tech companies start, they need scale, right? And you've got a population of 328 million. The other ones, of course, we could talk about are Tencent, the gaming industry, Alibaba, the Chinese economy. You're talking about 1 billion people. And I know this whole like Africa rising, I mean, Africa, everything, you know, every economist is called Africa rising at some stage, but Africa is not, it's not a country. So if we look at, let's just look at South Africa, right? We only have 55 million people. So do these tech companies have the economies of scale that they need to become the next Amazons, the next Tencents, Alibabas?
Sure, it's a valid point. And I don't think, though, that it prevents us designing tech companies for scale. If you look at a country like Israel, for example, they've got next to no people, but they designed their growth paths and sort of treated the US in some ways as their backyard for growth. And are we thinking about it in a similar way? Yes, we're only 55 million people, but how do we use that as a launch pad to get into other markets? And if we had been thinking more strategically, this conversation around the regional integration on the continent should have happened so long ago, because we've been delaying a market that's quite close and needs additional services. And it might have been Africa, it might have been other continents, but we haven't thought about it that way. How do we make sure that our products can get to scalable and big enough markets? It's part of how you design your product and how you build your business, in my mind.
Yeah, you've reminded me of one of my favorite books, actually. I read it ages ago. I'm not sure if it's still on the shelves, but it's called Startup Nation.
Yeah.
And it really is about how Israel has been innovative and grown and expanded its innovation to the world, and such a small nation, right?
Puny nation. I happened to be in Israel about at the time I think the book was launched, and at one of the conferences, tech events there, and I met one of the original founders of the Yozma Fund, which is the sort of the tech funds that kind of launched that VC industry. So it's a fascinating country, and Startup Nation was really a riveting read for me as well. But I think more than anything, what my time in sort of Israel showed was that, the impact of a coordinated and progressive public sector or government policy making strategy can have such a huge impact on how an economy forms and grows. Everything is just, it's not as haphazard as us, one minister's doing this, another one's doing that, private sector's doing something else. But the level of coordination and how it actually gets you to economic value was quite an impressive thing to see. I wish we could replicate more of that.
Anthea, can I just jump in there, following on with Rapelang's point, because do you think the 4IR summit that we had last year was the start of that, of government trying to be more coordinated in the space?
I was at that event. I think I was even emceeing it, and it's one of those tough conversations for me, because I think we're so good at talking the language and the fluff. But when it comes down to sort of the execution of it, how many people, in government or public sector are able to understand the technologies themselves, how they affect the different industries in the economy, what needs to be changed or fixed so that we can leverage the power of those technologies. And that really brings me back to the point where we've got lots of, innovators and startups, but are the buyers mature enough to actually procure those services locally? And typically they're not. So you've got all these startups, and the buyers in corporate and public sector are either not digital savvy themselves or progressive enough to want to procure those services. So what do? They outsource those buying decisions to, a top-notch management consulting firm. And what are they going to do? Cover their asses by buying an American product or a European product. So it's unfortunate that we needed to change sort of where the buying decisions are being made there. And if we don't have the internal skills to actually make it, then maybe we should look at a different purchasing approach. Instead of these RFPs where someone who doesn't necessarily understand technology will struggle to see which was good or right, let's go into more experimental modes. Let's actually say, if the Department of Water wants some innovative solutions, maybe they should just publish a data set and ask innovators, show us what you can do. And then they can come and do that and demonstrate something. And people that are not technology literate can actually see the outcomes and the fruits, as opposed to this conjecture all the time. But that requires us to change how we procure services.
Oh, that's a brilliant answer. I think great food for thought there, Anthea. We might have to get Rapelang to add a ministerial portfolio to her day job.
No.
Because she's not busy enough. So the other thing we need to talk about is kind of the listed companies, or the companies where ordinary people like ourselves can invest, not just the big private equity players. And of course, there are a couple of listed tech, in inverted commas, companies on the JSE. You've got BCX, you've got Blue Label. In fact, I must try not to confuse the tech companies with the telecom companies, right? But
it's all converging anyway.
It does converge, that's right.
Yeah.
And even, Michael Jordan, I spoke to him the other day, and he was saying he's kind of investing in 25 startups. I was like, first of all, I am a fangirl, but 25 companies to start up and run and try and get going in this environment is pretty tough to do. And the reason I bring him up is because one of the companies that I do want to invest in is Rain. His 5G business, his mobile communications business. But actually, the only way I can get exposure to it is through Patrice Motsepe's investment holding company.
Is it?
African Investment,
Okay.
So, and that comes with a whole host of other companies, which I'm not sure I really want to be exposed to, including, kind of including some very traditional, you're laughing because you knew what I was going to say about my competitors, but I won't say it. So some very kind of traditional companies that maybe I don't want to get exposure to. But, we've seen kind of the likes of EOH, the telecoms companies, obviously. Then there's also, and the name escapes me now because it had a name change recently.
Well, there's the Altrons, there's the Datatex, there's
Alviva used to be Pinnacle.
Alviva, yes. Oh, yes, okay.
So that's a company I quite like as well. But the makeup of the company is not an Amazon, or it's not groundbreaking, it's not new. The other one is just Naspers, and quite frankly,
we're too late to get on that boat.
You guys say that. Anthea, do you and Rapelang think about fintech, proptech, insurtech? I mean, would you guys include that in your technology definition and the point around convergence? And perhaps there's an opportunity to look broader into those sectors.
That's a very good point, Carol, and I'll come to that now. And just to start with Anthea's thoughts on, what do the local tech companies look like? For me, it's always been a concern that a big chunk of the revenue of our local tech companies is really around distribution and resell of typically European or American software products or hardware. And that puts us in a really vulnerable position, because in times like this, when an economy is tight, your vendors are not able to give you as much space and rebates as you want. Your customers want cost reductions. So you as a distributor or reseller get squashed into that middle, and you don't have the intellectual property to actually hold your margins in the long term. And that is really worrying for me, because it means we're not in the real game of tech stocks, where building IP is where you get your significant increase in value creation over time. And often I sort of look away from the tech stocks a lot, and I probably go to sort of what Carol was suggesting is, let's look at companies that were successful in the traditional industries in their own right, and which ones are the most progressive in adapting and consuming technology to become a digitally transformed organization or more responsive to customers' needs. So I think there's a lot of potential in fintech and proptech, as you were mentioning, Carol. And I would be very excited to see, one of these very traditional property listed companies become IoT leaders in their own right. I mean, they've got so many energy savings to get out of there. They could curate whole new office experiences for people using technology now. And if they lead that path, they already have an established market, and they're not the startup trying to get into a market to sell the technology into. So they could quickly become technology companies because of the market reach that they have. And I think those would be more interesting to look at than going for a so-called tech company. And if we allow those prop tech or fintech companies, to really flourish and grow and hopefully develop their own IP, then we might actually be able to see some of the value in technology in our local stock exchange.
So my concern with these fintech and proptech and insurtech companies is whether or not they can reach scale in South Africa. So I can see from a fundamental point of view, I can see margins, I can see revenue generation, I can see kind of all the very basic numbers that we use. But going forward, it's marketing and it's scale that worries me when I decide whether or not I should be buying these companies.
Yeah, and I think it comes back to sort of my initial thinking there. What I think is hugely beneficial about digital technologies now is that the ability to be applied in different markets is exponential. So you shouldn't be designing mining tech that will only work or be relevant for South African mines. Now with the kind of even VR and things like that, you could actually be installing this technology in a mine in Congo without actually having to go there. That's how powerful it can get if you design your business to be able to service markets beyond your immediate proximity and location. And digital technologies lend themselves to that for me in a way that traditional technology and hardware didn't. And if we think about it that way, then we're not limited to just the South African market. I can see that the South African market is small on its own. And until the company can demonstrate that it's able to cater for Southern and Eastern Africa or Western East Africa or something, you're not going to get the meaningful scale that you are looking for, Anthea.
Anthea, do you want to chat a little bit more around the management point that you mentioned earlier? I think we'd all be interested to hear what you and Rapelang have got to say about that. You know, how much emphasis do we place on the people in these companies? I mean, you mentioned Mike Jordan as one, but I'm sure the two of you have a wealth of information on that.
Certainly. So I think Rapelang has already kind of spoken to the type of companies or tech companies that develop. And again, I'm reticent, and in fact, this is probably, well, I was going to say Rapelang could talk about the difference between being somebody who is in corporate and being a tech entrepreneur, but actually, I think her 3 months in corporate doesn't count.
We can make it 10.
Okay, she can tell you that sad story. But my point was, like Michael, was exactly that. You know, all his life he was a corporate person. Does he have what it takes? And it'll be interesting to see how this unfolds, to take those tech companies that he is working on, and not all of them are tech companies, let me just clarify, and make them into these great listed companies where I want at IPO to buy as many shares as I possibly can into my portfolios. And I think the mindset is very different. So unfortunately, I think South Africans are still very corporatized, if you like. And I don't just mean the leaders, I actually mean the individuals, even us as consumers. And Rapelang mentioned it earlier on, you know, we're going to go and buy an American product over buying a local South African product. We really also need a mind shift to kind of this kind of cliche of supporting local. But if that's going to, we need to do that if we're going to have companies that are investable for the consumer. The consumer has to start buying local companies. And also you almost want to say to the consumer, well, get out there and do it. You know, nowadays there's online trading, there's online shopping, there's everything. You can do it. And still people are reticent about doing it. I mean, I've had a terrible experience actually during lockdown, because one of my favorite kind of investment companies was, well, not favorite, but the one I was watching quite carefully was Long for Life, you know, and it's a company where you look and think, oh, they're going to do great things. But during the crisis, I did some shopping at Sportsman's Warehouse, which is one of the brands that they bought. It was, I still don't have my stuff. This is like 2 months later. You know, I'm still running in short shorts. So, and so South Africans, we have to sort that out. And those, for me, that was a basic thing. You know, COVID crisis, you have an online store. I'm going to shop, buy some things online. Please make sure I get it delivered properly. End of story. Like, it, to me, it was just not that hard to do. And so I think also because companies or leaders in companies are aware that the online sales is not that great. You know, the tech kind of, the uptake of tech in South Africa is not that great. They don't spend money on providing the good online sales service and delivery, and also the good tech propositions.
And I mean, let me comment on that by sort of starting with the management side of that. I think there's lots of sort of skeletons in the graveyard of corporates that have gone the innovation and startup route. And I really like Clayton Christensen's work and thinking on this, that talks about whether people have had the right schools of experience when they go down a particular path. And typically someone who's brilliant in a corporate structure hasn't had the schools of experience of starting something from nothing and managing multiple parts of a sort of a business at once often. And it takes time to develop those schools of experience. And we need to, in the case of Michael Jordan, though, I think that it's more about, does someone have the runway to make enough mistakes, learn a lot, and come out sort of at the other end? And a lot of the time, if you've got very little capital or means to sort of support that journey, then you're going to run out of money before you convert your lessons into sort of meaningful value. And perhaps on Michael's side, he might be fine for that. He's got the timeline and the journey to get there. Because it's not that it's impossible, is that it takes time, and is your runway long enough? Is for me the bigger question. And when we look at the management of corporates today, I think there's still a lot that needs to be done in making sure that they are really oriented to this digital future. A lot of the time, I think we want to have one tech or digital person at most, if there's any on a board. And we still have many boards that don't have core technology skills on them, or executive teams that don't have core technology skills. And that's a real sort of failing there, because for me, one of the big challenges that we're seeing in corporates is that the IT guys are still a resource you deploy somewhere. They are not strategic partners and thinkers in the conversation. We have the business conversation and then go tell the IT guys what to do. And those are the companies that are really, really going to fall far, far behind. I always get fascinated when I look at the boards of like the Googles and the Facebook, and you see that the CFO has a computer science degree over and above the financial qualifications. It's a completely different paradigm of thought. They don't see technology as an additional thing on the side. And from my experience as an entrepreneur, when I graduated from UCT back in 2005 with a business science and a computer science degree, it was this battle of, do I go to a consulting firm and just do business analysis, or do I go to a software house and sit in the back and code for the rest of my life? Because just because I had technical skills, suddenly I couldn't be part of the business conversation. And I was like, yeah, this isn't going to work out. I don't know why I should be told what to do when I have the skills to do sort of both sides. And now we're still not seeing enough sort of that kind of talent coming up to the top of corporate. So that'll be a big thing to solve for. And on the other side of where the companies have responded, adequately to the times and COVID, I think the ones that aren't responding will probably see the dust anyway this year. And we will start to see the growth and emergence of people that were really in tune with their customers' needs and were open enough to explore how technology can allow them to solve the problem differently. And the ones that were committed to and in love with their solution and their approach are the ones that are going to really fall by the wayside and not reinvent themselves to the extent required. And by 2021, we'll start to see where they land.
They are very basic retail examples. Just if you compare Woolworths, Pick and Pay, and Checkers, everybody that I know is talking about Checkers 60/60. That's what it's called, I think, 60/60, where you can get your everything delivered within 60 minutes. And it's I think previously people wouldn't even have thought that Checkers or ShopRite would be the leader in online delivery. And yet here we are today, them way overtake Woolworths. Oh, there's a story about that. Way overtaking Woolworths and Pick and Pay to becoming the premier online shopping, grocery shopping portal in South Africa.
Absolutely.
Exciting example.
Two of you, because we've got some questions that we want to get to, if you don't mind, from our listeners.
Sure.
And I've been remiss because you've been speaking so well. So I want to just get to a couple of those. So Rapelang and obviously Anthea, jump in as well. We want to talk a little bit about capital. I want to conflate a couple of the questions that we've gotten. So simplistically, is there capital to invest in this tech space, simplistically? And then we've had an interesting addition to that, which I think is worth speaking about, from Ramonde, who's saying, as the 12J sector investment in terms of infrastructure and IP development? Do we need newer blood supported by unsure local investment with a tax net win maybe? So around 12J, what are your thoughts around that, Rapelang?
Sure.
Go
Yeah.
for it, Rapelang. You can,
yeah, my
ones.
internet
Anthea
seems
gets
a
the
bit
easy.
patchy. I don't know if you can still hear me.
Sorry if that was me.
Is it? Okay, cool. We can hear you. All right, great. Look, the Section 12J initiative, I think, was a great start to provide those kind of incentives to higher net worth individuals to invest in tech. But we do need a heck of a lot more. And I mean, even when you look at the size or the maximum size of a Section 12J, I think it's 50 million rands or so. And that isn't a big enough fund to really attract people to use that vehicle in my mind. So I anticipate that we will need to still attract a lot of international capital in that has built sort of this kind of VC sector before to work with local funders. And in my perspective, local funders to a large extent have not had enough of that early stage experience. So we've kind of taken private equity and made it venture capital, but it's actually just mini private equity, and they haven't changed the fundamentals of how they identify value and journey with the startups to create value. And it's actually very, very different. And we just don't have that depth of experience in the VC space, which is what worries me a lot. And the only way I think that we overcome this in the long term is for second and third generation entrepreneurs to go into the VC sector themselves. In my mind, there's only two ways a VC becomes great. Either they've worked in a super successful VC firm, and there's maybe a handful in South Africa that can be considered that, or they've gone through the entrepreneur value creation route themselves, so they can leverage the sort of experience. And we're very short of stuff on the right-hand side here. So I do think that this generation, my generation of entrepreneurs and the ones after us and before us even, need to start stepping into that role more if we're going to change the type of capital that is available for entrepreneurs today. It's still too private equity heavy.
Thanks. Anthea, anything you'd like to add on that before we go to the next question?
No, Rapelang got that spot on. Actually, in my view, Section 12J investments is basically just a wrapper that made it tax efficient. And what happened was the managers of the 12J took this tax benefit and didn't do enough about investing into companies, as Rapelang says. It's the mindset of being able to invest in a private equity venture capital business and to understand that it's going to take you 7 years to get your money back. So great that we can get retail or high net worth individuals to invest into private equity, because it's always so difficult. You have to be a qualified investor. It's a 7-year lockup period minimum. And the minimum investments are millions of rands, and we don't have millions of rands lying around, every single one of us, to do it. So Section 12J was a great idea, but the follow through was limited.
Thanks. Before we go to the next question, just to remind everybody who's on our webinar that for the pleasure of listening to our two experts, we each get an hour worth of CPD. So by doing, apart from soaking up knowledge. So thanks, Cartesian Talks, for getting us an hour of CPD, and the Scene & Code team will just email your certificate within a week. So that's it. You don't need to do anything other than just get your hour of CPD.
Great. Carol, if I can expand on sort of that, what do we need to do for sort of the tech sector? I think it's important to also realize that funding is one component of building a successful tech sector. The other part, which I think we've really not focused on, is how do we ensure startups can access the market, acquire customers quick enough, and grow and scale. And without addressing that question fully, all this funding, even if it arrives, will land nowhere. And the challenge with even funded startups is coming back again to the issue I raised earlier. The corporates that are selling into, are they really able and willing to procure from smaller businesses? And South African market is a little bit warped in the sense that we've got lots of mega enterprises, private sector and public sector, very little in the middle and lots at the bottom end. So these little companies are trying to work with mega companies, and it's not necessarily always connecting. And this is a much more tougher circle to sort of break into. So a funder, if I was starting a VC fund today, it's, in my mind, you've got to have a more systematic strategy for market access and how you're going to position your startups in front of the right decision makers. Without addressing both, you're really just putting the startups under a lot of pressure to grow in a sector that's very tight and gridlocked.
Yeah, very good point. There's lots of good ideas out there, but at how you're distributing that, and Anthea's point as well. The thoughts that you two have around 5G, internet access, data pricing, and how that hinders or not the sector, please.
I'm going to let Rapelang answer that. Much closer.
I thought you were going to give me some breathing room. Look, I always take a step back when we talk about a technology term, and instead of just focusing on defining what 5G is, which is just basically mega, ridiculously fast internet, let's take a step back and understand what are the human behaviors that are driving the uses and need of this kind of technology. And for me, what we really see there is that human beings have a relentless drive and need to connect with each other. And even as we are not meeting in person and we are connecting with people around the world, we desire and need to connect in as rich a way as it would be in person. And that means that we want to be able to work quickly enough. We want to be able to do hectic video calls where maybe we can actually see each other in 3D and stuff like that. We want to be able to immerse ourselves in another environment and make sure that it's, it's not pixelated, it's pretty rich. And when you look at that need to connect across people, different countries in richer ways, you will see that, this need for more and more communication tools has been with us for a long, long time, from the time we started with Morse code to now. And it's just going to get bigger and bigger, that hunger. So I do anticipate that 5G is going to make a lot of things happen, particularly in the education and professional services sector, that we couldn't do with the capacity of internet bandwidth we had now. And even though it's not going to be an immediate impact, in the longer term, that human drive and behavior is not going to stop at all.
Great, thank you very much for that. So Anthea, this one's for you, putting you on the spot. Mike wants to know, buy, hold, or sell tech. So buy, hold, or sell.
Mike, I'm afraid to tell you that this time really is different. So,
like a true asset manager.
Well, no, because Carl, if in 2008, you could have thrown a dart at the JSE Stock Exchange and bought a share and you would have made money. I think this time is different because there are companies on the Johannesburg Stock Exchange that are not going to survive or not going to make it through, And so there's a couple of tech stocks kind of swirling around in my head, in inverted commas, tech and telecom stocks that are swirling around in my head that I'm looking at, and in fact, portfolios. But it's not, there's no absolute, I can't answer buy, hold, or sell. Some of them are buys, some of them are holds, and some of them are sells. And actually, I think people should get in touch with me if they want to add into their portfolio to talk about where, because some shares, so one of the telecoms companies, for example, Vodacom, boring, like it just has not excited me from a dividend or growth perspective for the last 5 years. Suddenly I'm looking at it going, oh, there's one that's going to get through this crisis, so I'm going to add it to my portfolio as almost as a kind of just a stability stock in my portfolio, if you like. And it's not a bad dividend payer, but there's going to be no capital growth. Then there's the speculative stocks like the Alvivas, which used to be Pinnacle, where basically as COVID crisis hit and we all became kind of this live at work economy, they basically sold out of all their stock. So if they can now import new stock and then sell it, then of course, you know, they're going to make a decent amount of money, but it's a fairly speculative play. So should it be in your portfolio? Well, it depends on how your portfolio is constructed. So I've already given you kind of 2 sides or 3 sides of the coin. You know, there's no generic buy, hold or sell tech stocks in South Africa, if you like. And we spoke about Amazon earlier on. You know, so just to clarify, my decision, or even though it's been kind of this week's heated debate in our investment meetings, my decision with Amazon was it's probably going to come down a bit, but I'm going to ride this wave because I think that a year, 2 years out, it is going to reward me for holding the share, but it's going to be volatile. I think it's run so hard. I'm worried about it. Paychex, on the other hand, there's a tech stock that at a 25 times PE ratio in this stage, it looks cheap to me. So it depends.
Thank you. So I'm going to have a wrap up, and then I'm going to hand over to Rapelang for a closing thought, and then to Anthea for ending the seminar for us. So before I hand over to Rapelang, I must say, Rapelang, I've been asked by my friend Lesedi, who works at Easy Equity, to tell you how much he loves you and how much he's inspired by you. So when I told him that I'm hosting webinar,
thank you, Lesedi.
he was beside himself with joy. So, and I mention that because I want to end my part by saying to you and Anthea that I think you forget how much you inspire people. And in this time of pandemic and fear and anger, and when people are nervous, it is fantastic to listen to 2 smart people who are realistic, but also giving us tools to make the most of our money, to execute, as you said, Rapelang. And so thank you very much to both of you. It really is fantastic listening to you and being inspired by you. So closing thoughts from you, Rapelang, and then we'll hand over to the fantastic...
Sure. I can't help myself, Carl, but to look at that last question around, until a company lists, the average investor doesn't have access to that company. What are your thoughts on how an average investor can get in as early as possible? My answer is don't be an average investor. Otherwise, you can't get in early. No average investors get in early at all. And actually, there's a lot of online tools at the moment that are aggregating startups in the early stages that are looking for funding. And getting to those communities is the best way to find stuff early. So I'd encourage you to do that. And I guess my sort of parting thought would be that I'm a tremendous believer in the power of technology. And now with the kind of technologies we're seeing today, their capability to solve the problems at hand that we face in various industries and sectors is immense. And finally, it's able to match the capacity of our imagination. So let's not give up on tech just yet.
Well, I love the fact that we're talking about tech stocks on a webinar to over 100 people. And that for me already says so much just about how far we have come. Unfortunately, of course, it is an American tech company that we're using. So hopefully, you know, we'll look at South Africa in a year's time and go, oh, look, we've now got our own product and it works much better. It's slicker. You know, I think Rapelang summed it up quite nicely. Don't be an average investor. And what I'm trying to do with these webinars really is to educate people and to say, like, there are so many aspects to investing and you have to be brave and you've got to get out there. You can't kind of always just be spending money on nice things. You really need to be thinking about how you invest. And if you need to invest and you're going to invest, then you need to educate yourself. So I'll see you in a week or 2, I think.
We will indeed. Cool. And that's the end. And check us out on YouTube. Many hundreds of others look at these webinars afterwards. And let's all make sure that tech is not on the side and take up Rapelang's challenge. Tech is everywhere and let's make sure we use it. Have a great rest of the day, everybody. Thank you.
Sure.